Okay, this is the combined weekend podcast for the advanced swing trading and day trading courses. It's August 12th, 2018. I'm about a third of the way through producing the videos from the workshop weekend. I think they're really good. Um, a lot of goodness in both the research materials and the live trading workshops. So it was a lot of good lessons to learn there. Looks like there will be about 100 case studies from the trading. Um, so I'm going to go through the day trading questions first. There's a few more of those, and then I will get to the swing trading one. Okay, so the first question: what's my definition of an expert level trader and a journeyman trader? I haven't really used the word expert. A journeyman trader I have as a way to distinguish between a novice and an apprentice and a journeyman, and I'm going to use the dictionary definition because that's what I do. A journeyman is a skilled worker, so has skills and is working, who has successfully completed an official apprenticeship qualification in a building trade or craft. And that's exactly the way I use those terms, that term of art. Um, I consider this to be craft work. Journeymen are considered competent and authorized to work in that field as a fully qualified employee. In other words, I think you can do it as a job, and you are operating within the bounds of your authorized authority. So, to me, a journeyman trader is someone who is self-sufficient with the system, and this is like my first. I spent about 2 minutes thinking about it. These were the ones that came off the top of my head. These are pretty reasonable. Has the basics of plan, prepare, execute, and assess down the four phases that I talked about. Follows instructions, and that means you follow your own work procedures, any rules that you develop, or if you're trading a mechanical system, you follow the instructions of the mechanical system accordingly. You have a professional mindset. You've mapped out your processes for all four phases, so you know what it is that you do in order to plan, to prepare, to execute, and assess. Um, those processes may not be final yet, but whatever it is that you're doing, you do have a process mapped out and you're following them. And you're studying them for improvements as a result of your assessment phase, but you have mapped out those four phases. You reliably conduct self-assessment on a daily, weekly, monthly basis and complete all of the THARP tasks of trading regularly. You have an accountability partner. You have two systems and can trade them both according to their rules, and you can conduct analysis of performance in order to make changes in behavior. So that to me is a self-regulating system. And the reason I say two systems is because then you can demonstrate that you can compartmentalize um, two different systems, and you can trade each one according to its rules. An expert, I would just say, I mean, I don't usually use that term. I normally just think of it as a um, master craftsman, but I'll accept expert as a substitute for that. Maybe an expert is on the way to master, I'm not sure. But I think the difference there is I would say an expert has five systems, and you have systems in multiple time frames, and you know the systems well enough to be able to teach them to others, and that you can take moments of insight in the routine trade to suggest ideas for R&D of new systems or refinement to existing systems without blowing up the trade that you're in. So you have the presence of mind or the mindfulness to notice questions or insights that occur to you while you're watching the routine trade. That there's part of you that's monitoring the larger environment while the routine part of you is just handling the trade. and you can follow through on that. You can notice that idea, jot it down without jeopardizing the trade you're in or feeling the urge to override the trade or to experiment. That, in other words, you can operate in the area of you're supervising yourself making the trade. That's the point I would make on that one. And then you have the ability to turn that into some follow through for some independent research, some R&D. I don't necessarily see that as a journeyman. I think a journeyman can make micro improvements in your little work circle on the system, like a system tweak. But I think the expert is able to start looking at the area beyond the limits of the system and can look for ways to expand the scope, even if that means starting a new system. Question number 1 for intraday trading. It really answers itself. Do I use 3-minute or 1-minute charts? Some videos show 3 minutes, others show 1 minute. So yes, the answer is I use both. I prefer 1 minute. I find 3 minutes to be a long time. But there are times when I use 3 minutes. I'm primarily a 1-minute trader. Question 2, for the hybrid frog, do I wait for the candle or bar to close, or do I enter as soon as price breaches the line? I'm not even using candles on that one. I'm using a line chart. And so as soon as price goes through that number, I'm in. If price drops back inside the frog box by the time I have a chance to enter, do I still enter? Well, I set them up as limit orders. So once it crosses that line, that thing fires. And so I'm in. If I did not use limit orders, how would I enter? I think that's probably the other question you're asking. This is how it is. So if that's the open, and I've drawn my hybrid frog boxes here, and price starts coming down, bang, I'm supposed to enter. And so maybe I don't have a limit order in, so I try to put my order in, and before I can hit send, I notice it's come back in here. So now I'm inside this frog box. I won't go short while it's doing this, but if it does this, a 1, 2, I'm back in. And certainly if it leaves the box a second time, I'm certainly in there. But I want to be in the direction that it is signaled. But if it's come back, I'd like to see it roll over. I'll take a 1, 2 or a 1, 2, 3. That's acceptable. But the limit order is the one that I want. Question 3, how to assess the quality of a P1? You can't, that I know of. Because you're asking for information that you don't have available yet. In retrospect, it would have been a quality if it went all the way through the Bollinger Band mean. Oh yeah, then that was a better quality signal. Now that's kind of the superficial answer. Are certain conditions considered better quality than others? I think I'm going to start asking you, Peter, to put in your own suggested answers so that you can start internalizing these ideas. So let's think about the owl. So I've told you before that I don't trigger on P1 anymore. I wait to see the owl. So what that means is I consider the owl to be a high quality P1 kind of entry. And the certain conditions turn out to be the conditions of the owl. So the first thing that had to happen was one, an unambiguous move. Unambiguous move. That means from the open, it had to have moved 1.4 frog boxes. Why is that? Because the open and the hybrid frog is how I like to get in, so that's 0.7. If it moves another 0.7, I have one execution risk in hand, and because so 0.7 and 0.7 is 1.4, and 1.0 of a frog box, by definition, is signal and not noise, then 1.4 frog boxes is a pretty good signal. So there's an unambiguous move. Number two, there was a P1, meaning that a regression line crossover outside of the river. Number three, there was an RLXD. The 10-period regression line has crossed the dragon. The dragon has rolled up, is 4, and the 30-period regression line has rolled up. So those are 5 conditions that makes the owl a better quality than just a P1 by itself. There's a follow-up question here. Hold on. Yeah, so I would say the larger the initial move, up to a certain a larger initial move means that this is clearly signal that something strong is happening. That this symbol, maybe it came out of a close, or it was a Z3P. So the more this looked like a period of quietude and sideways quiet channel, that would actually make a larger move have a more significant P1. Right? The quieter this move was, then the more exaggerated this move looks like. And now both of those tell you that the traders are now in charge of this thing. That everybody agreed on the price when it was up in that sideways quiet channel, but now one of those traders, in this case the bears, really dominated in this period of time. So this thing is on the table. It's in play. So the bigger that move, the better the P1 should be. But in terms of the owl, no, as long as those 5 criteria occur, the RL10 crosses the dragon, then the dragon rolls up, and then the 30 period rolls up. As long as those conditions are all in place, then that makes this a pretty good entry right in here. There was a question, do I find there's a time frame that owls are more likely... Let me try to expand this a little bit. Is there a time frame that owls are more likely to follow through? For example, now on 1 minute might not even look like a move on a 3 minute. It would look like a pocket. Yeah, I think this is how I would answer that. I think if I'm looking at, so we're talking about day trading right here. So if I'm on 1 minute, 3 minute, 5 minute, 10, these are clearly pure intraday trading time frames. When I start thinking about 30, 1 hour, 2 hour, and then daily, weekly, monthly. Listen, if this is pure swing trading down here. This is all swing. These charts in the middle are like a combo of part day trading and part swing trading. So these are almost like a hybrid time frame to me. And so clearly swing traders, they don't care at all about 1 minute up to 10 minute. So they really don't care about that. But if you were trading on a 30-minute chart and you had something like an unambiguous move on a 30-minute chart that had moved long enough to be an owl, you know, you had something. You might have had something like this. This move that could have lasted 90 minutes on a really big move. You might have had 30 minutes of this sideways chop, and now on this, for this much recovery to have moved, this might be another 30 minutes. All right. And on 30-minute charts, this might have been 3 big candles down that terminated in a doji and then had something like this. All right. That's what it looks like on a 30-minute chart. On a 1-minute chart, it looks like this enormous red Niagara, and it might have had 1, 2, 3 moves down, and then this sideways quiet channel chopping in here. And that might even be a Z3P at some point, or at least a sideways quiet channel. Well, if it was that big of a move, it probably isn't a super pinch. But you might get a Z3 pinch inside here. And then you get this measured move out here. And that could be a whole frog box of a follow-through. And this might have been a frog box here as well. And so all of those pieces of information are meaningful to us on 1 minute. You know, and so your owl entry might have been right in here. Well, on the 30-minute bar, that might only begin to get their intention. And if they saw this, and if the previous days were these big down days, and they saw this move, they want to come in and short that. And so that owl is going to fail, because now you have some fast swing traders that are coming in, and they want to pile on and make your owl fail. Right? So one of the things that happens is on the owl in your time frame, if that thing really works well, you get 1, 2, 3 legs up. The very fact that you have success here means that the next higher time frame guys, the 3-minute, the 5-minute, the 10-minute guys, they may want to come in and start crushing this thing down. So when you get your little measured move, you got to be very strong in here in your 2R battle drill. Now, a lot of the times, my wins are 0.6. That means that most of the time, there's not even a follow-through to 2R. So the owl simply says, yeah, this thing has a reasonable chance to get to 2R, but don't believe in it. Remember, this is the owl is a counter trend trade. And the trade you want is that one, is the collapsing dragon. So even though the owl is working, at every time you're waiting for this thing to collapse and you're not later than entry, is the collapsing dragon. That's the easy one to believe in. Because all you're doing is you're reinforcing, you're getting the second leg. The first leg was the unambiguous move, which allowed the opportunity for the owl. But the second leg is the big one. That's the easiest one to believe in. So while that owl is happening, you cannot afford to have some belief that you actually picked the bottom. Okay? So to get to Jake's, back to Jake's question, I'm going to say that pull that over. So the time frame I would say is for the intraday trade. To me, the 1 minute owls happen the quickest. That if you take a look at the intraday trade and you have 30 minutes in the morning, from the opening. So these are 30-minute chunks. And then you have 4 of those until you get into the lunch period, which is about 3 more, like a 90-minute period. You got like 2 hours for that. If that owl happened in here, you got 2 hours for that owl to be the excellent move. And again, most of the time it's not even following through. So to me, if you wait like a 10-minute owl in the morning, there's really not that much time for it to follow through to lunch. But I would say, just mathematically speaking, that most of the time the owl is not going to get to 2R, but it can reasonably get you a 0.6 of a frog box. So I tend to prefer the 1 and the 3 minute. Once I see, if I'm up on the 30-minute, I'm already thinking like a fast swing trader. And if I see an owl on the 30-minute, then that tells me I'm really thinking like a swing trader. And I want to get that owl entry. And I may have seen a 3 or a 4 or a 5-day unambiguous move down. And then the whole river has turned, and the 30 has turned, and the dragon has turned. I get an owl entry. And I'm really looking at a multi-day swing trade just to get back to the previous fair value. And that could be 2 ATR. So that's going to be a big move that unfolds over time. And now as a 30-minute trader, that little 1 minute trader, all that is kind of noise. So that's, we're like 1 times 3 is 3, times 3 is 9, times 3 is 27. We're like three echelons, 3 time frames above the 1 minute. So that truly is noise. So if the RL90 and the 270 are headed in the same direction of the owl on a shorter time frame, you could get some better than 2 hours. Yeah, that would be the case of, and this is the idea behind the RLFF, if I may say it that way. And this really applies to both the swing trade and the day trade. So what could happen is that you could have the RL270 way up here. And so everything is still on the sunshine. It's in the summer. And the price may have actually pulled down here a couple times. And so the 90 has kind of rolled over. And the 10 followed price pretty quickly, and the 30 rolled in here like this. And so now the 10 has rolled up, and you get some kind of owl like this. So when you see that kind of a move, the magnitude of this, the RL10, here was the bottom line of the RL10. It has moved that far away from the RL270. So now we're getting into RLFF categories. If this is the long-term fair value, and the traders, and this is the beauty of the Z3 pinch. So if this was all tightly compressed, and then this collapsed and it pulled that far away from the RL270, then this tells you how far the traders have moved it away from the long-term fair value. That could be 4 ATR on a swing. Intraday, you might see that as 4 frog boxes for a day trade. And when that thing starts rolling back, now you have a reasonable estimate of fair value way up here. And now you can say, that is the return to normalcy. Now, the other side of that is, what if you had a Z3 pinch? Whether that is a, intraday, that means the Z3 lines are less than 1 frog box. On a swing trade, maybe that's within 2 ATR. Everything is tightly compressed. Now you get this breakout, and I'm going to still draw it this way. So now you get this breakout, and now you get this little owl. Well, the RL270 may have been flatlined in through here, and this amount of distance might only be 1 to 2 ATR or frog boxes. So the fact that the 270 and the 90 are all tightly clustered in here says this first move is not much of a move. But if you had seen a large divergence from the 270 because of the previous trend, then this move up might be a bigger, better one. So that's why I like using that RLFF as a calibration of fair value over multiple time frames. Okay? Does that answer your question, Jake? Yeah, the RL90 and the 270 are very useful tools on the shorter time frames to see what the lower term time traders are thinking. Because remember, if the RL30 is significant to me, like that was the final turning point in the owl. If you went up 3 time periods, the 90 and the 270, right? The 270 is the 30-period regression line of the 10-minute trader. If I'm on 1 minute and my 30 is here, when I go up to the 3-minute chart, the 90 on the 1-minute chart is the 30 on the 3-minute chart, and on the 10-minute chart, roughly the 270 is roughly the 30 RL for the 10 period. So his fair value, for the 30-minute chart is probably what I see as the 270, or that's the RL10 or something like that. Yeah, nobody uses RLs the way I use them that I know of, Jake, and that's our strength, and it's also a careful limitation. So we're able to make judgments on the use of the RLs because of what the statistics of them mean. What other people tend to use, when you just read a lot of books, I see a lot of 10, 50, 200. The 50 and the 200 have a lot of power traditionally from the early heroic days of technical analysis. And you see like the 5200 is called the Iron Cross. That we know from, if that's the 200 period moving average, that price above the 200 we consider to be a bull market. I don't need to have them on there, Jake. I find the regression lines give me plenty of information. You'll notice on the health check, though, that I do have the 200 on the daily chart. Just as a reminder, that's how powerful that thing is. And it's a question for you of how much junk you want to have on your dashboard. Okay, so the 50 in long bull markets, you get this distance between the 50 and the 200 becomes enormous, and then price comes down below the 200, and because everybody knows that should be a support level, you'll notice that I put a 2% band and call it sideways if price is within 2% of the 200. When this thing rolls over and takes off, everybody would look at this as a support level. So it's not the precise 200 so much as it is this region, this plus or minus 2%. So one of the ways to get away from that over precision is that people use the 50 as the fast and the 200 as a slow. And so when price is in a bull market, price should be greater than the 50 and that should be greater than the 200 when everything is moving in an orderly fashion. You have price, you have the 50, and you have the 200. So that's the fast moving average, and this is the slow moving average. Well, all we've done with the moving regression lines is that by using the 10 and the 30, and by extension the 90 and the 270, these fractal ones, all we're doing is that we're tightening up the definitions of these regression lines. And here's why I do that. The iron cross is when the 50 crosses the 200. By the time that did that, price crossed it, and this could be another 2 to 3 weeks of waiting for confirmation that the 50 has now crossed below the 200, and now everybody would say, the old traditionalists would say, yep, that's definitely a bear. Yeah, you could be down another 20%. Price could be 20% below the 200 by the time that happens. It might have fallen 20% from the swing high just to get down to the 200, and then another 20%. So you could be down 40% before that system says, yep, you definitely are in a bear. So I don't want to wait that long. So how do you handle that in a world in which when computational power is basically free and you can study anything? Well, one of the things you'll see, guys, is they have a 10 period, a 20 period, a 30 period, a 40 period, a 50, and then the 10 rolls over, and then the 20 rolls over, and then the 30 rolls over, and then you get this kind of turning point when your slowest one is now on top, and you get this, it looks like a price ribbon of moving averages, and everything collapses into this singularity and then splays out to the bottom. It looks like a bow tie. All right, so just put that on your chart sometime and take a look at this. I just find that by having those 4 regression lines, the RL10 is the price, the 30 is a confirmation, the 90 and the 270 act as the 2 higher time frames, that I have plenty of information to act on, and I never am surprised by these 50, 200 rollovers. So as you become a journeyman and developing expertise, one of the things you try is these different combinations of indicators. It should always be tied to a decision that you have to make. And to me, if you have a set of rules, those rules create decisions. And then when and those decisions lead to performance. And when you look at performance, you're looking at what you actually captured versus what you actually missed, right? So if as you do your analysis, if it turns out that there are measured moves that you're not getting, then it tells you that maybe it's time to be adjusting the rules so that you can make decisions in time in order to improve performance. So I don't just put things on the chart just because other people look at them. What I'm looking at is that my rule set, informed by indicators, the indicators are how we calibrate and mathematize those rules, leads to decisions, to performance. And if my analysis says, oh, I'm happy with what I'm getting, but oh no, I see an opportunity to get more, either by a continuation pattern or adding a second position or refining my exits. This is, if we got back to the earlier question about an expert versus a journeyman is managing these rules and maybe making micro improvements. An expert is out here in this area taking a look at what do the rules don't get? What don't they get? And is it time for a new chunk of rules to start getting moves that I'm not getting? That, to me, is what an expert does. Okay? All right, I think, let me double check the, okay, I think I answered all those questions. Okay, question number 4. How to catch a hybrid frog? Use limit orders on a small handful of targets. How do I limit the number of open positions? Use one cancels the other, or have a button with your broker that allows you to cancel open orders. When you've hit, say you set up 10, and the first 4 hit, and that's how many you wanted to take, then you need to be able to cancel the other 6 with one stroke. Your broker should be able to support that. If not, you need a new broker. Question 5. Suppose I have a hybrid frog position and I see a P1 forming, indicating the coming of a counter trend. Should this be used as an exit criteria for the hybrid frog? Yes. Get paid. Start stalking the owl in the P1F. So remember, if you have a hybrid frog, it already moved 0.7 in your favor. You know, there was your open, and now here's your hybrid frog bracket, and this price went down. Boom, you're in, and now you got one execution R in hand. So this is 0.7, and that's 0.7. That's a 1.4 move. So what should happen here is, look, how long should you stay in that trade? As long as it's going down. And if that was the slope of the downward pressure, you see this thing starting to, it's failing at a uniform rate, then that P1's not going to form. In fact, what you'll see is the RL10 is here, and the RL30 is following it nicely, and the dragon will be in here. And so everything is down, and then at some point, this thing will start to turn around. So, you have a 1, 2, 3. So if that was the swing low, and now all you got to decide is, how much of that do I want to keep? How much of that do you want to keep? Me? I want to get paid. The better that move, the longer this thing lasted, the better this move, the more of that I want to keep. So a 1, 2, 3, that's enough. Or the RL10 crosses the dragon. We're already into the third criteria of the owl. That's enough. So somewhere, or you might just say, let me put, if I put a hybrid frog off the bottom and it moved up that far, I would certainly get out. How many of these hybrid frog boxes did it actually make going all the way down? That's, yeah. So if I get money in hand, here's the other thing. If my average win is 0.6, and if I'm holding 0.9 on this hybrid frog move and it's starting to stall, take it. Just take it. Get paid. Don't ever let an above average trade give back enough so that it's now a below average trade. Why would you give back 0.3 or 0.4? If you give back 0.3, you turned a move that was 1.5 times your average trade into an average trade. Why would you ever let that go back above and become a below average trade? So it now becomes a matter of money management and psychology. The workbook for the research weekend has a nice summary flashcard on this one. I'm going to record a separate video on that one and put it as a lesson in here. But that's the basics right there of journeyman trading. Knowing what it'll give you, knowing what your histogram is, knowing what your average trade is. That's what being a journeyman is. You have become a professional in your preferred system. I'm going to come back to, I just realized I didn't answer question 3. I'm going to come back to that one. The owl and chain trading exit strategy. Which one to use? What I just said. The 1, 2, 3, then the RLXD, One of those two is going to be a good one for you to use. I wouldn't use the Z2 line as a stop. You can use that for swing trading. That actually works okay. But once you're about 10 or 15 bars into the system, usually by that time the PSAR or the RLXD is going to be fine. Or it's a pure money management stop. So I would use the Z2 line as an initial execution stop, maybe. Yeah. And then once that trade starts working, the Z2 line starts getting a little too wide and it becomes more of a money management. That's really I'm going to tell you, pick a rule set, whether it's 1, 2, 3 or the trailing execution risk. And then study those results and study the histogram and see which part of that is not satisfactory. Do you want to capture the move sooner or do you want to give it a wider range? And then from there you can start adjusting it to satisfy you, not to satisfy me, but to satisfy you. So I think the moving execution stop is fine, the PSAR is fine, and then the strike where you just say, hey, on a money management basis, I've seen enough. The rest of the market is rolling over. I don't want to wiggle around anymore and just crush it. The live trading workshop had some really good examples and some good lectures on that one. Let me come back to number 3 here. Yeah. I wanted to show you. You gave me a couple charts to look at here, so I'll just do that. And so your question was, let me make this a little bigger. Is RLCO2, and I guess you mean this one down here, is RLC2 a better RLC setup than RLCO1? It seems to be smoother. 2 seems to be smoother than 1, in which case the RL10 crosses back to the other side. Yeah. Well, here's what happened. The reason this particular RL2 seems better is because the previous move to this RLC was a pretty strong move. It came out of a support level down here and moved smartly up into here. And then really the long side is different than the short side. People want things to win. They want to go long Home Depot. And so when this pullback occurs, that looks like a buy on dip opportunity to everybody who owns this. And to everybody that owned it earlier too. All the mutual funds and the pension funds that are out there own shares of Home Depot on the long side. So the long side, every pullback looks like a buy on dip. And it took a second fail at this swing high for the owl really to trigger and work. Oh, notice that's why the owl is a better entry than just a P1, especially on the downside. Because the 30 rolled over, the dragon rolled over, he had the RLXD, and now that's a beautiful owl. It was a double top and then a failure. And then the very size of the original move gives you a 1.4 frog box, an unambiguous move. So remember, the river was up, and now this was a counter trend, and now it's an orderly move. Now everybody that wants to buy Home Depot can now buy it at 197 and a half instead of at 200. That's a 1% sale. So of course everybody wants to buy this. And as soon as it starts working, it confirms that yeah, this really was a buy on dip opportunity. So the owl on the short side, after a downward move, look how nice the owl entry is. Why would you squirrel around with this RLCO? If you bought this here, you had to suffer this pullback. Just wait for the owl. In both cases, the owl is the thing that works. And if you get short at the RLXD and you cashed at the RLXD, I'm going to ask you, how much more do you want? How much more efficiency do you think there really is to squeeze in and out of this? There isn't much more. All right, so this one, how to assess the quality of an RLCO, or is it just a matter of retrying until it works? Hey, let's find the owls on this one. Here's an unambiguous move up. You get the P1 outside the river. You have the RLXD. You have the dragon rolls over, the 30 rolls over, and now you're short right where my arrow is with a stop above the swing high. Boom, you're short the whole time. There's a P1, yeah, but the 30 hasn't rolled up. The dragon hasn't rolled up, so you just notice that. In fact, you can get short right in here again. When the RL10 rolls over and you have a 1, 2, 3, you're short a second time. And you're short a third time. But now you finally have an owl entry here, and you get this move. Bam. So, I'll say it again. Use the owl. Use the owl. What should you do? You should use the owl. That's what you should do. And you should be prepared to trade it 1,000 times. So I don't get this. I took the long RLCO2, but then got stopped out and then missed the entire uptrend move. You should be ready to trade the next 1,000 signals at a risk level that allows you to trade this routinely. That's like saying I was playing poker and I put my antes in, and neither one, I didn't get good cards, so I lost my ante, so I didn't play the third hand. I was expecting to have a winner within 2 hands. No, you got to play 1,000 hands. And so you just, yeah, this is a better signal. In fact, if you saw this one, you would say, oh, RLCO1 didn't work. RLCO2 didn't work. Oh, but RLCO3, the third one that you found, that's an owl entry. And it failed to fail further. Let me try, where's the, yeah, so if this first RL, you know, and I'm just going to extend the RL10, if that thing had not reversed here, then I would expect the path of price to follow this line because it's connected to this first RL10. But instead, it went up here. So now the RL10 is doing this. So I expect it to follow this line coming down. But it didn't. It went here. And this time, I expect it to fail on this line. But notice that you have this a lower low, a lower low, a higher low. But now you have a higher low. And now, when you draw this line, this is 1, 2, 3, and up. Let me clean that up. So failure to fail further is information. So you had a low, a lower low. You had a high, a lower high. That's a downward channel. Those failures are supposed to happen. But after 2 tests of a P1 and a P1, look, in this entire unambiguous move down, there was no P1. And then you had 2 P1s, and now you have a low, and this time when it reversed, you have a higher low. So when I draw this line across, this creates the pocket inside here. This is the emerging dragon because it took out the previous swing high of that RL10. So what I want to say is, if you got your little trading target things here, your preferred targets, it's like playing poker on these day trades. You got to be prepared to play 1,000 hands with your rules and capture the incremental advantages that you get. You cannot get emotionally exhausted by having two trades that scratched out. Right? And look, this one, if you got in right here and it moved this far in your favor and it came all the way back here, you got to be scratching right here. That is a zero trade. That cannot wear you out. That has to be like, oh, I got my money back. And this one, if you got in here and it went this far to the Bollinger Band mean and starts to fail, you got to be out right here, because this is where you got to get short. You got to get short at both of those places. And if that's where the preferred trade is, the collapsing dragon, then you can't get exhausted by the fact that, oh, that thing didn't follow through and become the great winner that I wanted it to be. So you got to monitor your emotional bank account here. The only reason I could see not to take this pattern here is because you thought those were going to win and they didn't, and now you feel like you had two losing trades. To me, those are two scratch trades. And I'm prepared to trade 1,000 of those in a row, just like I'm going to play 1,000 hands of poker when I sit down to play poker. I have to have enough emotional resilience that I can play 1,000 hands. That's my mindset. That's a professional mindset. You know, if you were a journeyman carpenter and your job was to go in and start nailing 2x4s into the frame, and let's say the first couple you didn't hit the nail perfectly cleanly and you had to hit it a couple extra times, would you say, oh, well, I got to give up my profession now because there were two nails I didn't drive exactly perfectly? No, you would just say, well, that's part of the stuff that just happens in a profession, and I'm going to keep going back to work. So that's the mindset I think you got to have. The lack of emotional resiliency in those kinds of conditions come from having too much money on every trade, so that you ride this emotional roller coaster because you actually expect each and every one of them to work. And when it doesn't work out according to the ideal, you start suffering emotionally, and that's how you get mentally tired. And then that's why you don't take trades, because, well, it's not going to work anymore. They all look the same leaving the station. And of all things, that one is actually better. So does that mean I should not take? Well, here's what I'll tell you. You got to take the owl. If you take the owl, you got that one, and you got this one. Wait for the owl. The owl gave you that one, and the owl gave you that one. And when you see this move, you have these three enormous moves up, and it has a topping tail and starts to roll over. And there's a 1, 2, 3 exit right in there. How much of this do you want to give back? Especially when it's hesitating at a price level where it failed the last time. That's the 2R battle drill right there. As soon as you enter, you get your, how soon can I get my stop to no lose? It starts to fail against me. Just get paid and see how that feels for a while. To start getting partial payment. Start collecting some rent. Get paid. And tell me what that does for your emotional resilience. That's my advice on that. All right. That was all the questions from the swing. I'm sorry, that was all the answers from the day trading questions. Let's go to the swing. I got spoiled at the hotel where we did the live trading workshop. It had among the fastest internet connections in our county. So I'm out here in the sticks. Where the connection's not quite as fast. I'll trim all this out of the video once we get it processed. Oh, this is brutal. Sorry, guys, that this has taken so long. Well, the questions were brief, and maybe I can find the email they were sent on. Hold on. The answers are posted in the in that project in Basecamp. I don't know why this has taken so long for us to get the. Doggone it. Let's try it again. Oh, there we are. Sorry. Thanks for hanging in there. Yeah. So, question one. Watching for continuation patterns. Oh, killing me. Okay, sorry. So, watching for continuation patterns. The entries are easy. After an exit, I find that I frequently miss a resumption of the trend as I don't have a screen for it. I've looked at evaluating the Dow 30 and 32 and ETF 32 for relative strength and looking for green on weekly and monthly as a general continuation. Can I suggest some ways to screen or catch them, possibly another RLXD? Absolutely, the RLXD or a 123. If you look at the 6 weeks of portfolio management, you'll see that I do that all the time. You cash a winning trade, usually because of one of those two exits, and then instead of failing all the way back to entry, it reverses and you get a universal entry or an RLXD or a 123 pattern, and you're right back in. So that's exactly what you do. When you look at the lesson on the daily preparation, you'll notice that I have 3 different categories of potential targets. So identifying potential targets. The first one is new swing trade patterns have fired. The second one is all the usual suspects, I'm always ready to trade. And the third one is a potential continuation pattern on any symbol that I traded intraday that day or where I recently cashed a winning swing trade. So I always know at the moment of exit the price I'm going to get back in at, because I know what the essentially taking out the high of the exit day. If it opens and then crosses right back through that, I'm already back in the next day. So I like to keep those continuation patterns on for a couple days for swing trading. That's a good reason to specialize in a series of symbols. I think you can look at, if you're a journeyman, if you're a professional, you can look at 60 charts a day. You can look at a chart in 5 seconds and determine if there's a continuation pattern setting up. So you should be able to look at 60 charts in 3 minutes. So I'm going to say 10 minutes. I gave an example of that in the live trading workshop, where you just put TC2000 on a screen show and had it flash like every 5 seconds. And so we were able to detect pretty easily. And you'll see an example of that in the lesson, what that looks like. So I would just become expert in those 60 symbols and study those patterns every day. Second one, would I mind explaining the X days as a way to fit into or complement the RLFF patterns? Yeah. Let me do that. Let me also answer this last one. Hey, the weekly reports, I mean, it comes out on the weekly email, so save them. But also the Yahoo group has an archive of previous sendings, and you should be able to download the weekend reports from there as an archive. If there's I keep them all anyway. So if you need a package of them, like you want to study a certain time frame, I can certainly do that as well. I keep all the daily and weekly reports and the market health check for like the last 10 years. So I keep that as a research package. So if you're interested, let me know. Okay, so the X holding days. Let me just pull that one up real quick so we can see what we're talking about here. Alrighty. So now I want to look at SPY holding X days, right? So the first, I'm going to look at 40 days, 20 days. If we scroll down further, it'd be 10 and 5. And so I'm just going to give the answer for using 40 days. So let's say that I had a 5-day down pattern, and I got a swing trade entry, and I've been managing it, and now I'm 40 days into the trade, and it's starting to show some topping behavior. Maybe it's starting to roll over. I'll say, well, how good has that trade been? How good has it been for those 40 days? So what I would do is come down here to the average and say, the average 40-day holding period for the S&P has only been about 1.85%. And the best 40-day holding period for the S&P has been 14%. And that the boundary between a very good above average and starting to become exceptional is average plus 1 standard deviation. So here's how I would look at that. Let's say I was at 3%. I had only gained 3% in the last 40 days. I said, man, that's not very good. And it's starting to roll over. I said, this is not showing anything like an extraordinary move. So maybe I would cash that. But if I was holding plus 9% at 40 days, I would say, man, this thing is already like 2 sigma. Yeah, that would be like a plus 2 SD trade. And then if it started to show me a 1, 2, 3, I would definitely get out of that thing, because it's already gone well beyond what I had any reasonable expectation to hold. Now the interesting, so that's basically how I do that. The other thing I would say is that you can use it for is you can say, I know that the average hold of these mechanical signals are like let's just call it 5 days. It's between between 5 and 10 days. Sorry. So I would look at that and say, if the average 5 day holding period plus one standard deviation was 2%, and I was holding plus 4% after 5 days, I would say, that signal just gave me an actionable piece of information. It gave me a way to get into a trade that was twice as good as simply the naive random entry and hold for 5 days. So there's information content available in that. So by looking at this list of symbols that you have, this is simply the way that I use to look at like the 9 sector spiders, gold, Cliffs Materials, Treasuries, Microsoft, oil, and then all the big fat indexes. This is just the way that I use to calibrate the difference between what my systems ought to be getting and then a random buy and hold and then sell after X days. It's just a way to calibrate the conditions of the market and then comparing that to what the system, the particular signal is doing. Like if my signals were only giving me sort of average returns or average random returns, then there's not information content in there. And then that would tell me that I'm only getting market noise. Okay, so that's, I don't know if the answer was worth holding out that long, but that's sort of the bottom line on there. That there's a couple, we can now start combining that with something like the RLFF on the swing trade, where if we did something like, let's say we saw the RL270 was way up here, and the RL10 has come down to here, and then we measured that distance, and we said, hey, that was six ATRs. And we could say, let it move. If it moved 2 ATR off the bottom, if it moved 2 out, then I would have a reasonable expectation of getting 4. And then we might use that holding X day periods and say, on average, how long does it take to gain that much, take that much, get that much money? Or here's what the average return looks like. And as long as this thing is starting to move and it's better than that long-term average, then we would say, yeah, there's information that this is a better than random market move, that there's actually people buying this because of the value opportunity they saw here. They saw the trader's price down here was different than the long-term fair value. And then once price started moving in our direction, we could buy it here on sale with the expectation we might be able to get that. Okay? So that holding X day period simply gives you an idea of what that long-term market, the random market tendency to go up over the long period of time, what that actually looks like. Okay? All right, that's everything I wanted to cover. That was all the questions. I'll try to clean up the replay so we get rid of that quiet period in the middle, and we'll just take it from there. Okay. So that's all I got. You guys take good care. We'll see you in the chat room, and see you again next week. Hey, the sooner you can get me the questions, the better the answer I can provide you. So if you can get them to me like by Friday or Saturday, that would probably be a little better. Okay. But otherwise, just send them when you got them, and happy to answer. Take good care, and keep your wrist measured and your powder dry.